Okay. It gives researchers the opportunity to channel their research results into the policy layer, and it gives policymakers an opportunity to get background information based on economic research. Today, we will talk about a fiscal stabilization function for the euro area. Whether the crises that have haunted many euro area countries over the last few years more or less persistently are over is in the perspective of the observer. What is quite clear, however, is that there are inherent risks in the construction of the monetary union that need action by policymakers and researchers alike. They should find mechanisms to control these risks. The suggestions for these mechanisms are plentiful. Today we are going to talk about which one will work. More specifically, we are going to talk about an unemployment insurance scheme for the euro area. Thank you very much for joining this debate. I will now hand over to Daniel Groß, who will talk about the challenges ahead, about arguments, and about the state of the discussion. Daniel, it's for you.
Thanks a lot, Brigitte, and welcome to everybody. And there's lots of free spaces in the beginning, in the first rows here. So sit down if you want. It's a really pleasure to have this conference once again with Intereconomics. And the fiscal stabilization function in the Eurozone is, for me at least, something which we call actually in German an evergreen. It's a topic which has been around quite some time. And I'm speaking as somebody who had the occasion already quarter of a century ago to contribute to the thinking about how to set up an economic and monetary union, which wasn't called the Eurozone then. And of course, the first thing we did then was to look at the experience of the United States. People said, and we have a representative here who can talk about that. Okay, let's look at the US. They have a common fiscal equalization mechanism, and they have a common unemployment insurance, so we have to copy it. That was the thinking then, but as you will see, I think during the course of the day, it has been somewhat refined over the quarter of century that has passed since these very first thoughts. You should keep in mind, however, that when we discussed EMU then, okay, we were perhaps a bit naive, right? But in the end, after rather careful considerations, we decided that we could go ahead without, right? So that should give pause to thought to those who believe it's obvious that we need something. The only thing we can talk about is which form this fiscal stabilization function should take. Now, the first topic today, as Brigitte already mentioned, is unemployment benefits. And that's a topic which, sounds again much more neat and straightforward than it is in reality. And I think the presentation by Caroline will show you immediately that it is actually very, very complicated, and it's very difficult to make general propositions, some of which actually Sebastian will give us later, and he will distinguish between those propositions which he thinks are true and those which are a myth. And then as I come back to the experience of the United States, which I find fascinating, because, and here I'm speaking under your control, it wasn't until 1935, I believe, that there was no federal, no federal element. There was, yeah, exactly. There was state unemployment, no. Not even. Okay, good. But and when I think Roosevelt tried to have something, then he was thwarted by the Constitutional Court, which insisted on limiting his initiatives because of the state rights. Just as a very small parenthesis, And partially because of his initiatives being rejected by the Constitutional Court, there was this famous court packing idea, which was formally, I think, that justices should retire at a certain age.
No, he actually wanted to make it bigger.
Yeah, he wanted to make it bigger, right?
So he could get the majority.
Yeah, exactly. Right, some people today might, but he had actually majority to do so. But in the end, there was so much opposition by what we would call today civil society and others, that in the end it was not done, although technically he would have had the majority stram it through. Just to say that when we look at our own situation today, where of course member states are very much concerned about their own prerogatives in the field of fiscal policy in general, but unemployment insurance, of course, in particular as well. We should not forget that the United States lived for 140 plus years without having this particular element in place. Now, enough said. I think we can now get into the details of how to construct a European unemployment benefit insurance scheme. I am very vague here because, as you will see from Caroline, that there are many ways to go about it, and she will speak to a large study which we have done recently, and which brings out some of the complexities and some of the things that could actually be done. Caroline, the floor is yours.
Good morning, everybody, and thank you all very much for attending this session. So my name is Caroline, and I work as a researcher at CEPS in the Jobs and Skills unit. And as Daniel had already announced, we recently concluded a very large project on the feasibility and added value of a European unemployment insurance scheme that I would like to talk to you a little bit about in this session today. So just quickly the outline of the presentation. So first introduction and background, then we will talk about the design of a scheme, added value, feasibility, and then some key conclusions. So this project that we actually recently concluded, it was commissioned by DG Employment and initiated by the European Parliament. And the idea of the project was to really try and understand, would it be feasible to introduce a European unemployment scheme in sense of legal and operational terms, but also what would its added value be in terms of the economic impact that we can expect. And so this assessment was done for all of the member states, for the euro area and for the EU. And we didn't look into a single scheme. We actually explored 18 different schemes. So I can think that from this slide you can already see what kind of a large and complicated project it actually was. Okay, so the background. So as Daniel had already introduced in his opening speech as well, so especially after the crisis, EMU's institutional architecture has been widely criticized. So this dual strategy of having the common monetary policy and national fiscal policy, it actually proved to fall short when we were faced with the crisis. So when EMU was first started, national fiscal policy was believed to play a very important role when we were going to be hit by a shock, but actually the experience of the crisis showed us that sometimes fiscal policy proved out to be only a limited impact and sometimes even pro-cyclical. And in addition to these issues, the EMU, of course, is also faced with other concerns and barriers, such as market failures, so price and wage rigidities, labor mobility, which is still fairly low in Europe, spillover effects, given that our economies are so closely intertwined, shocks really spread very easily through the system, but also countries know that they can benefit from the efforts of their neighbors, so this could result in suboptimal spending, and then the current account imbalances, which again were believed to become less relevant in a monetary union, but actually proved very difficult to overcome without the exchange rate mechanism. So already in earlier documents, but especially in the recent 5 Presidents' report, there has been this call for a fiscal stabilization function, meaning an automatic stabilizer that would be as responsive to economic shocks as national tax benefit systems would be. So we need an instrument that helps us to prevent economic shocks, but also mitigate their impact. And of course, over the course of the crisis and also afterwards, many instruments have been further developed or new instruments have been introduced. And you can see a few of them on the slide here behind me. But none of these instruments really serves as an automatic stabilization mechanism would. So some of these instruments that you can see, for instance, public investment and regional policy, they are very important, but they only have a delayed impact. So they are more likely to contribute to economic growth rather than having this stabilization function. Other mechanisms only prevent economic shocks or try to absorb their impact. So all of them would be complements rather than substitutes to this automatic stabilizer that we would be interested in. So why a European unemployment insurance? Because this is just one of the many options that exist. So of course you can also think of a scheme that would be attached to GDP or an output cap-based scheme. But actually an unemployment-based scheme like European Common Unemployment Insurance would have some very specific advantages in the sense that unemployment benefits are automatic, anti-cyclical, and very fast. So they have a high multiplier effect. They really target those who bear the largest costs, social costs in the crisis, and they could really be seen as a sign of solidarity. Also, when you think about measures, for instance, based on output gap, the output gap is not observed. It is frequently revised. So having a measure that is based on unemployment, so based on a headcount, which is more easy to measure and for which data are more readily available, this could actually be an important advantage. Of course, there are many, many obstacles, and we will deal with most of them in this presentation. I just listed a few here on this slide. Okay. So how can we actually design such a European unemployment insurance scheme? So in our study, it was really tied to short-term unemployment. And the key choice to be made is, do we want to go for an equivalent scheme or a genuine one? At least that's how it's usually presented. So how does it work? Well, a genuine scheme actually would function in a very similar way as the national schemes that we all know today would, in the sense that unemployment benefits are paid out directly to eligible unemployed, and financing comes from employers and employees. So this means that the genuine schemes, they function continuously. So any eligible job loss that would qualify for benefits would result in benefits being paid. And also, this means that the genuine schemes would actually at least partially replace the national schemes that we have today. So when somebody would be eligible for the European level, for the European benefits and the national ones, the European benefits would take the priority. Equivalent schemes are very different. So they would really be introduced as an additional layer on top of what is already there, so to reinsure the national schemes. So this means that all financial transfers, so the pay into the scheme and the payout that comes out of the scheme, flows between this European fund and the member states. So that's a very important difference. And in our study, the scheme does not function automatically. It is activated by a trigger, which I will get to again later. But given that this really functions as an additional layer on top of what is already there, of course, it leaves much more flexibility to the member states when it comes to how they operate their own scheme. Now, of course, it's very easy to explain this distinction in this way. It seems quite intuitive, but of course, in reality, it's really not as clear-cut. Many of the existing schemes in federations, they actually combine elements of both. And I think that Suzanne can also testify to this, that really the American example is a very good one. So there we do see that employers and employees are contributing to these unemployment benefits, but you also have these very interesting systems of the extended and the emergency benefits, which function with a trigger. So it's not really black and white as it may seem. And both of these types, of course, can be designed in many different ways. So you can play with parameters like benefit amount, the duration, eligibility conditions, the trigger, and so on. What we do see is that most of the proposals in the literature and also in our project, we do have schemes that are equipped with one or two mechanisms, which are the experience rating and clawback. And these mechanisms are there to prevent permanent transfers, but also to try and deal with moral hazard. So experience rating is a mechanism that ties the pay into the scheme to the use. So countries that would use it more pay more. And clawback is actually a mechanism that serves the same purpose, but it becomes active only when countries really are starting to run a deficit vis-à-vis the fund. So after a few years, when some countries really have gained many more benefits than they paid into the scheme, then the clawback becomes active. So all these mechanisms really are there to deal with this issue of permanent transfers. Okay, so I think I covered most of this slide already. And this slide is just really an illustration of what these different genuine schemes could look like. So differences in replacement rate, eligibility, debt issuing possibilities, and so on. And this is for the equivalent. So this trigger, the way it was designed in the project that we did, was as follows. So the unemployment benefits, or basically the financial transfers, would go to the member states when the short-term unemployment rate in a certain quarter in the country would exceed its 10 years average plus a certain percentage. And this percentage can be very low, which makes it really easy to trigger the scheme, and then there are a lot of transfers that are being paid to all of the different member states. Of course, it can also be very high, and then hardly any transfers are being made. But then, of course, there is the risk that the threshold is so high that it's very, very difficult to actually activate the scheme, even if you would be faced with a very severe recession. So all of this is important to keep in mind. Okay, so we spend a lot of time in the project looking into what added value it could actually have, such a European unemployment insurance. And given that this whole discussion is really fueled from this idea that we need an automatic stabilization mechanism, macroeconomic stabilization, of course, is an obvious first choice to study a bit more closely. And so this stabilization is actually achieved through 3 different channels. The first one is enhancement of national schemes, then there is geographical insurance, and then intertemporal insurance. So what does it mean? So the enhancement of the national schemes. So many studies have actually argued that national unemployment insurance schemes could be very important to provide macroeconomic stabilization, but in practice in many countries, they don't really have, or the potential that they could have is not fully exploited. And the reason is that the coverage of these schemes and their generosity very often is low. For instance, one of the cases that we examined was Hungary, where unemployment benefits are limited to a 3-month period, which of course is not very long and doesn't offer unemployed individuals a long time to find a new job. So this could have an important impact. And so just as an illustration, so the chart that you see here behind me really shows the differences in coverage. So how many short-term unemployed actually receive unemployment benefits. And so the red bars are the national schemes, and the blue ones are one of the the European unemployment insurance schemes that we assessed. And you can see that actually the shares are much higher by design in the European scheme. So one can then, of course, ask, okay, but why do we need this European level? Can't we just strengthen the national schemes? And the answer to this would be that it would be politically and also fiscally very difficult to achieve this without some sort of common backstop. Because, of course, when these schemes start paying out a lot of benefits, they become very expensive for member states, precisely at a time when we are faced with recessions and precisely when governments are looking for budgets that they can cut to reduce costs. So just to keep this in mind. Where the European unemployment insurance really makes a difference is the geographical insurance. So this reallocation of resources across countries, which of course is a true risk sharing. So especially important when there are asymmetric shocks hitting our member states. And the intertemporal dimension becomes very important when there are symmetric shocks or really extended, very long downturns. And here the ability to issue debt could also play an important role. So what do we find? So we do see that the European unemployment insurance scheme, it does have a clear stabilization impact, which is highest at the start of the recession. And this is what we expect because the scheme is, of course, tied to short-term unemployment. So, and for instance, in the equivalent, it is activated when the trigger is pulled. So in this sense, you really see the stabilization impact there. Of course, it's not a huge scheme. So you can see the size listed here on the slide. So it's less than 0.5% of euro area GDP over this entire period. So the result that you have also really is in line with the scale of this scheme. Our simulations also suggested that there are no permanent transfers. So there is no country, if you take a sufficiently long period, there is no country that only pays into the scheme and no country that only draws benefits from it. So these experience rating and clawback mechanisms, they really appear to work quite well. Okay. A European unemployment insurance, of course, besides the macroeconomic stabilization impact, can also have other effects. And one is a potential impact on labor mobility, for instance, by making benefits portable. In our study, the conclusion was that this impact on labor mobility likely would be limited because portability of benefits already exists today, and actually the use of this scheme is very limited. Also, this would be operationally quite complex to establish. And then another important point, which I think especially in recent times is very important, is the contribution that it could have to social Europe. So this upward convergence, strengthening of the national schemes, really improving the coverage of those who are unemployed, and the legitimacy of the European project, which again is a very important question that we are dealing with today. So really the sign of solidarity, social cohesion. So we also have some estimates for the impact that it could have on inequality, on reducing poverty. And here we see again a clear impact. And then of course, all of this really could fit into this idea of the European pillar of social rights. Then there is also a legal chapter in the study, which I will briefly also discuss with you. So one of the main questions here is how can we actually introduce it? Would it require a treaty change? And there has been some discussion on this in the literature. Some authors had argued yes, some authors had argued no, but it depends on how the scheme is designed. Our legal expert argues that for all of the schemes that we were studying or for most of them in the project, that it would be feasible to introduce them within the existing framework, so without a treaty change. And so on the slide, you can see the legal basis that he identified for this purpose. But of course, remember that some of these articles, such as that Article 352, it still requires unanimity of voting, so it's not an easy fix to not have to deal with this treaty change. When it comes to the member states, it's very clear that genuine unemployment insurance schemes, precisely because they partially replace what is already there, they would be operationally and legally much more demanding to implement than the equivalent, which really are this additional layer on top of what is already there. But of course, it depends on to what extent there are minimum requirements for the national schemes. So, for instance, if we look at genuine, so our legal experts there found that amendments to ordinary legislation in all kinds of domains related to social security, unemployment insurance, labor markets, and so on, would be needed in in all of the member states. And as expected, the largest impact is there in the countries which today have a very different scheme. For instance, this Ghent scheme that you can see on the slide. In Scandinavia, we find such schemes, which means that unemployment insurance is voluntary, and it's really managed by the social partners. So, of course, having a voluntary scheme or having this European scheme, it's a very big gap to bridge. So, just to wrap up some of the main things that we examined in the study and some of the conclusions that we draw when it comes to the design. So whether we go for a genuine or an equivalent scheme, both have their merits. And this really is, in the end, a political choice on what kind of system it is that we want. In any case, minimum standards on the national schemes are very important, again, with this coverage and generosity in mind. Experience rating needs to be there, but no clawback, because they serve the same purpose. And clawback actually could be activated when countries are still recovering from recessions. Ability to raise debt was also very important, given this intertemporal insurance. And then this last one, so the ability to change parameters during recessions. This is really inspired by this American system of extended and emergency benefits, which, if I'm not mistaken, but I'm sure that Suzanne will correct me if I'm wrong, which really had a very important impact in the crisis. And so for the equivalent, it all came down to the trigger, and for genuine, as expected, so really raising generosity and coverage to make sure that the stabilization impact that we are looking for is really there. So if you're interested in a study, and then you can find all information and also all of the outputs on the Commission's website as well as on the CEPS website. And then I just want to thank you once again for your attention, for bearing with me in the very first session of this conference. And I hope that we will have a very exciting conference. And I really look forward to the presentations of the other speakers. So thank you so much.
Thanks a lot, Caroline. Before I give the floor to Sebastian, just tell you a little secret, which is that this study, which appears quite anodyne, I think, to experts in the field, was extremely contentious, politically contentious. And that is one of the reasons why it was actually delayed by almost a year, no, between 6 months between the finishing it and us obtaining the permission to put it on our website. I think that can tell you a little bit about the political passion that is lurking behind this topic. Sebastian.
Okay, sorry. So welcome everyone. Thanks for coming, and thank you for the organizers for putting together this very interesting conference. I'm very happy, despite the political issues around it, that we are here and we can continue to discuss the European Unemployment Benefit Scheme. I'm going to talk about what I perceive as being the lessons from 10 years of discussing this. I have taken the 10 years because this is how I perceive the, let's say, modern debate on the European Unemployment Benefit Scheme. It has rightly been mentioned that this is a much older debate. It goes back to the Majolin report in the 1970s. I think this is the earliest proposal which I have found now, but there has been a renewed interest from the late 2000s onwards, and 2007 was actually the first workshop I remember where I presented a proposal on this, and then there was Laszlo Andor later, after the Euro crisis hit, the EU Commissioner for Employment, who pushed this very strongly, and I think he's also mainly responsible, together with others, that there was this tender and this very big research, and by now we have a vast amount of literature on that, and I think the best and most comprehensive piece is actually the study you have put together here, and I would like to go through what has been published and point out what I think are robust findings. I have 5 of those. I would say they are, well, more or less common sense, or more or less most people agree on that, even though some might still disagree. I then would like to point out 3 popular myths in a way that I think there might be some truth to it, but in the way they are stated, they are overdone and they are a bit excessive. And they are still used in the popular debate on this. And then finally, I would like to point out 2 remaining complications which I think have not been resolved yet, and which, well, if this ever gets to an implementation stage where I'm still skeptical, might be things we still need to look into. Let me just start with these things and go through them very quickly here at this stage, and then I'll go more into details. What we know and what I think we have learned over the first decade or a bit more now of the euro area, 15 years, is that first, insurance through markets in the euro area does not work as we have hoped. So financial and capital markets don't insure as we had hoped before. Second is that the fiscal rules we had in place, they were not sufficient to prevent pro-cyclical fiscal policies. The third is that macroeconomic shocks actually can be so large that self-insurance might not be sufficient. The fourth is that transfer systems which are based on measures like the output gap are extremely questionable. I'll come to that more in detail in a moment. And then, this is what Karin already said, equivalent systems are much easier to implement than genuine systems. What I think are myths is, first, that in federal system fiscal stabilization is small. The second myth is that if we had more cross-border migration, we would not need to have a transfer system at all. And the third is that stabilization through European Unemployment Benefit Scheme is so small that it's negligible and that we don't need to bother. And the 2 remaining dilemmas, which come out of the combination of these conclusions and the political debate, is that first, I think the equivalent systems might not stabilize as is hoped, and is also simulated in this study here. And second, that some of the compromise solutions, which have triggers and so on, that they actually might limit the benefits of European Unemployment Benefit Scheme. Let me now go through the details. First point I made is that insurance through markets in the euro area did not work well. If you look at the economic textbooks, they will tell you you should have risk sharing through markets. That means households should diversify their portfolio. They should not invest in home assets, but in cross-border assets. And if a shock hits and they become unemployed, they can still draw, capital income from their assets. And so they are not hit by the shock as extremely. And second, if there is a asymmetric shock to a country, the agents can borrow in international markets to smooth their consumption spending over the cycle. What we have seen in the euro crisis is, and in the crisis of 2008, 2009, is that this didn't work very well. First, households' portfolios are not diversified in the euro area. They were not, and they are still not. Households mostly have their primary residence as asset, and even if they have financial assets, they have a home bias, which is still there. And second, the private sector had borrowed before the crisis so much that when the crisis hit, they were not able to borrow. And actually, banks were refraining from lending at that point, and they actually cut back cross-border lending. So these channels just did not work as hoped. The second finding is that the fiscal rules did not work, and I think this is also not much disputed anymore. The idea was that the Stability and Growth Pact would make sure that the countries have enough room for maneuver if a crisis hits. And together, I mean, the medium-term objective of a balanced budget and the 3% rule. Reality was that countries ran pro-cyclical expansionary fiscal policies, and they just could not react very well when the crisis hit. And there were a number of reasons for that. First is some countries just ignored the Stability and Growth Pact, and then Germany and France reformed it in a way that countries could go on ignoring it. Then second, it's asymmetric, so you can go up to the border of 3%, nothing happens, but if you then go over it, something happens. So many countries found themselves very close to it. And third, the output gap measures, which then were introduced to estimate whether you are on your medium-term path, they actually gave very, questionable signs. So they were showing in 2007 that Spain was having a negative output gap, that meaning being below capacity, and of course, so if they had a surplus, they could just cut taxes and spend the money, which with hindsight, of course, was not a good idea. The finding number 3 is that in a monetary union, the asymmetric shocks in at least extreme scenarios can be so large that self-insurance might not be sufficient. So the original hope always was in the discussion of the European monetary system that, you don't need to have a central fiscal budget because the countries always can borrow in financial markets if a recession hits. And if you go for a European monetary union, these markets would be more deep and more easy to access than for nation states, and so they could self-insure through this way. In reality, we saw that some shocks were so large that investors got scared, and when the countries actually needed the access to financial markets, they were cut off financial markets. And the two most relevant cases here are Ireland and Spain. In 2006, 2007, everyone would have said they have very solid public finances, they had budget surpluses and low debt to GDP ratios. But when the banking crisis hit, this pushed their debt level and deficits into territory where investors actually got scared. They started to fear default and demanded higher risk premia. And so the absence of a lender of last resort in the Eurozone actually made this self-insurance mute at this point. Finding number 4. Transfer systems based on output gap estimates are questionable. This already was Caroline said. We had some proposals in this discussion, in the early part of the discussion, which were saying, well, why don't we just introduce a very simple system? If you have a negative output gap, that means produce below capacity, you get money. If you have a positive output gap, you pay money in. The problem here is, and I think this is also common sense by now, that the output gap estimates are inherently unreliable. Even though the new methodology of the Commission is much more complicated than before, the description runs to about 100 pages, it still is not very reliable. You have very, very strange things what they are showing. They are showing now that Spain is almost close to full employment with unemployment 10 percentage points higher than 10 years ago, and so on. So these things are really questionable. And I think this is more a philosophical question because we cannot measure the output gap, and it has nothing to do with the methodology. I'm not very confident that we are going to solve this issue anytime soon. If you look back, we had some cases, as I said, Spain, in the original data, it looked like they were below capacity, significantly below capacity in 2007. With the current data, it's showing they have been overheating. If you had based the system on these output gaps, they would have received money in 2007 to spend and actually made the situation worse. And so this could destabilize the cycle more. And plus, it's very difficult to explain these kind of transfer payments politically. If you, go into a recession and somehow the filter says, you are doing fine, and then you have to pay into Brussels budget. So this, I think this is pretty much off the table. Robust finding number 5 is that the equivalent systems are easier to implement. This is also what Caroline dwelt on. Again, genuine system is where you have a claim to an individual has a claim to a European unemployment insurance. Equivalent system here, I think I used a slightly different definition than you, is that there's a central fund which just disperses money to national unemployment insurances or national budgets. And because these genuine systems have to interact with national systems, both economically and legally, with active labor market policies, passive labor market policies, and so on, they are extremely difficult to implement because the countries are so different. In the European countries, they even differ in the way how the tax treatment is of unemployment benefits. So you see there the problems start. Technically and legally, this would be a huge task to implement that. And in addition, politically, this is probably not very realistic because whenever you touch the social system of a country, you have all these interest groups, employers and employees linked to that. So it would be extremely difficult to implement anything like this. So I think if we go for something and want to have it soon, an equivalent system would be the solution here. Now let me come to the myth, to the things which are stated, but which I think are nevertheless not correct. The first statement is that in other federal systems, fiscal stabilization from the center is small. And there is a key reference here, Hasdrubal and others from 1996, which is probably the most widely cited paper in this whole debate. And they claim that in the US, federal government only stabilizes a very minor part of asymmetric shocks. They say the government comes in their calculation to 13%, credit markets to 23%, capital markets to 39%, and 25% remain unsmoothed. This paper is relatively carefully written. However, the way it is quoted is usually not that careful anymore. It starts here with a part of the asymmetric shocks, and there are a number of other problems with this paper, and I would like to just briefly touch upon them. I think the first problem is that this methodology systematically understates the role of the government. What they are doing is they look at state GDP and check in how far any change in state GDP is reflected in the end in consumption expenditure in that state. And if not all of a drop in GDP is reflected in the consumption expenditure, they say some of that is smoothed. So what is the problem with this? The first problem is if the federal government goes and says, I spent money in construction programs, building up homeland security or so on in a recession, this would not show up as stabilization because that would bring up GDP. You would never measure this drop, and it's out. It's not measured. It's not included in this measure. The second problem is if you have a deep recession, which is not asymmetric, but something like the 2008-2009 recession, then it's also taken out because the authors use so-called time-fixed effect in their panel regression. This is especially important in this case because, as we will maybe hear later, the US system has these emergency and extended benefits. So in a deep recession, usually the state's unemployment insurances get money from the federal side in order to pay out longer benefits. Again, this is by the methodology just taken out and not considered as a stabilization by the federal government anymore because these years, most states then get the money and this is not included. And the second problem is that the methodology, in my eyes, systematically overstates the roles of markets on the other hand. For example, they count if GDP falls profits fall at the firm level, but household disposable income doesn't fall equivalently. They call this as cross-border risk sharing by capital markets. The problem here is if a domestic firm, let's say a California-based firm, sees profits fall and continues to pay out dividends, as many firms do, this is seen and included as cross-border risk sharing by capital markets, even though there has been no capital flow between borders, and this is due to the fact that they don't have the data to see where the company is located and where the household is located. But again, this overstates, because I mean, this is not cross-border risk sharing. This is just how an economy works, and they include this here. The second problem is if households just adjust their consumption by less than their drop in income, so let's say they get unemployed and they spend their savings on consumption, again, this is called cross-border risk sharing by credit markets. Even though, again, if it has been an account by a California bank where the savings are in and they spend it from person lives in California, I would not consider that as cross-border risk sharing. And because these things are put on the financial market side and we have not measured some things of the government sides, I think this paper systematically misestimates the role of the US federal government in shock absorption. If we take this lesson to Europe, it means that EUBS might be more important than some people think. And second, that if you hope to get significant stabilization by capital markets union and banking union, this is probably overdone. Let me come to my second myth. Some people say, well, don't bother about European unemployment insurance and stabilization, but we need more cross-border migration. Then we don't need a transfer system. I think this is a bit misguided. I'm in favor of cross-border migration. This can help to make the economy more efficient if you take some skills who are not needed in one country to another country, but pushing people to migrate in the wake of a recession, even if it's a 2-3-year recession, might actually not be very helpful, because if you go beyond the bottom layer of the qualification, or the top layer of the qualification, you have many cases where you would just destroy human capital if you make people move. For example, if you have a Spanish bank teller who has lost the job in the deep recession, and you force that person to move to Germany, the person speaks Spanish and knows the Spanish customs, well, he could work in a bar or in a restaurant, but you would, in fact, destroy the human capital here. So the question is, what do you really want there? And I think what Caroline said, that EUBS might, if it's portable, it might help migration. This is a positive fact. It doesn't force anyone to migrate, but it helps efficient allocation of scarce skills without having this side effect. But it's a complement. It's not a substitute for migration. Okay, the second myth is that stabilization through the European unemployment benefit scheme is negligible. Sometimes it is reported as saying, well, let's look at the whole period and we look on average for each year how much higher would your area GDP have been, and in one of her tables, Caroline's table, it's actually been presented that way. I think this misses a bit the point, because I think it's much more important to look what marginal stabilization in deep recession is, because that is when countries would need this help from outside. And here the impact can be sizable, and I'll show you in a moment a graph with a number I've taken from the CEPS study for Spain in 2012, where a significant part of the drop in GDP actually has been stabilized. And this is important because the business cycles, and especially in terms of the European crisis, have important non-linearities. Investors don't get scared if your GDP drops by 2%, but at some point they get completely scared and they pull off finance, and then recession deepens in a nonlinear way. And the second point is, if unemployment rises too much, there might be nonlinearity in political risk. I mean, what we have observed in France prior to the elections, the rise of Marine Le Pen, this probably has to do with the fact that unemployment has been high. And so there might be a trigger point where just the interaction of the political system with rising unemployment might also be problematic. And if you take this into account, the benefit might be larger. Here's the graph which I promised. This is Spanish GDP, and you see the first drop in 2008, 2009. Then the economy was recovering a bit in 2010, very marginally. You hardly see this in the graph. And then you have the new drop. And this drop here was by 3.9% basically. Now, if you look at the simulation, of course, I have to admit I took the most positive simulation, the most positive scheme here. But in one of the simulations, this has been reduced by 1.6% of GDP. So what you see here is not a marginal stabilization, but it's a stabilization of 41% of a drop of the GDP we have experienced. I mean, this is significant. This is not something insignificant. Of course, it doesn't happen all the time. It only happens in deep recessions in some cases, but then the benefits might be substantial. Let me now come to the two dilemmas, and then I'm done. The first dilemma, which I think we still have, is that the equivalent system might not stabilize as hoped. Most of these systems work the way that you look at unemployment or employment figures, and if they deviate very much, then the country is sent money from the European level. In order to be sent money, you have to hit a trigger, as Caroline explained. And for that, you really need to have the data. This is a bit of a problem with the European semester, because how the system nowadays works is that the governments in the fall, around September, have to put together their budget for the next year and then present it to Brussels, plan the expenditures, and so on. And now assume you plan, well, you see your economic situation isn't really great, and you plan with, well, some rise in unemployment, but not enough to trigger this thing. And then sometime in April, you find out you have been in a deep recession. I don't know how exactly in these systems, when the European level then would, once the data is there, decide that the funds are dispersed. But let's assume the government in May gets the funds. Usually it's very difficult in the budget process to then start spending this money additionally. And this is still a bit of an issue, that this would probably need a fundamental reform of budget processes to make this work in this stabilizing way. Because if the government just takes the money and uses it to reduce the deficit, this might help stabilizing debt sustainability, but it would not help in macroeconomic stabilization. Yeah, so I've said before, the genuine system is very difficult technically and politically to implement and legally, but it would not have this problem. The equivalent system does. The second dilemma, which I see, is that some of the compromise solutions might limit the benefits of the European Unemployment Benefit Scheme. I also, at least that's what I read into your simulations, that the more tight you draw the clawbacks and experience ratings and restrictions on how much a country might draw from this fund, the less the stabilization impact is in a deep crisis. We are now having some proposals on the table. I don't know how many of you are familiar. The Italian government has brought up some proposals with different ways where, which at least in my interpretation are clearly aimed at diffusing northern European fears, where they have things like national compartments, at least in some of their versions, so that the country only pays into a compartment and can only borrow so much from it and so on. They also have clawback mechanisms. But the problem here is that if you really include it this way, then the series limits stabilization impact of the scheme. I think it would be, well, it would be very sad if we end up with a system, or if we implement a system where it takes a lot of political capital to get it through, and then we end up with something which doesn't stabilize. And especially because some of the concerns the Germans like to bring forward, or the German government likes to bring forward, are in my eyes not completely justified. For example, the way moral hazard is usually discussed in Germany is, I think, a bit simplified in this respect. There's very good research also in your study from Frank van der Burg, who had looked at the interaction of different government levels when it comes to the introduction of such a scheme, which I think is very relevant. Well, if you try to push, let's say, if you have a national system and a federal system, that you try to push some recipients into the other system, or that you focus your active labor market policies on people you don't actually pay for and not on the others. These things are all very relevant. But in Germany, you very often hear, if we introduce such a system, then the other countries have no reason to flexibilize their labor markets anymore. And this is not what we want, and therefore we cannot have such a system. And I think these arguments are fundamentally flawed, because actually you would get more out of such a system if you have a flexible labor market, because what we know from labor market theory is if your labor market is flexible, in a recession you lose more jobs, but you get them back more quickly in an upswing, and you might have a lower level of natural unemployment, but because this is linked to short-term unemployment, you don't gain anything from keeping your labor market unflexible. And because some of these concerns are unfounded in my eyes, I understand that politically one might want to address them, but economically it doesn't make sense to me. Okay, so now have exhausted my time and my slides. So let me come to the conclusions. Well, overall, to summarize that, I'm amazed how much progress the idea of an EUBS has made, and I really think this is a great study which we are discussing here. And well, if you are not that much into the topic, I can imagine that you might not have gotten everything we have been saying here. If you read the summary, I don't know how many pages your summary has. This is several hundred pages, but if you go deeper into it, there must be several thousand pages of documentation now. But the summary is a very interesting read if you are more interested in the topic. Interestingly, there is still some political movement now, and I hope that this at some point leads to some proper policy action. My hope is that political compromise does not reduce the idea to ineffectiveness, because then we might be in the worst of all worlds. Thank you very much.
Thanks a lot, Sebastian, also for being so generous with our big study. I think, yeah, you were quite right. Even the summary is about a dozen pages or so. And I think you have an idea of the complexity of the problem and of the discussions we are having here within our little Eurozone. And that's why we are turning to our big brother. Susanne, you have been billed as an expert on unemployment insurance in the US. I hope you can enlighten us.
Hi, everyone. It's a pleasure to speak to you all today. I work for the U.S. Department of Labor. That's actually why I was invited, because during the Great Recession, I oversaw legislation related to unemployment insurance at both the federal and state level. So all of these extensions and expansions, I had the pleasure of having to suffer through. But I do want to make it completely clear that I'm not here as a representative of the U.S. Department of Labor. So everything I'm saying is completely my own idea and nobody else's. Well, anyhow, I was asked to come today to be a discussant about both Caroline and Sebastian's presentations. So what I thought I would do would take some of their key points and give you some of my American perspective based on my experience living and doing a lot of what you're thinking about doing. But I guess I had a couple of thoughts based on actually, Daniel, your original, opening statement. And I would, hope that consideration of the U.S. as a possible model will continue, because 25 years ago I wasn't working on this project, so hopefully I can help convince you all that there is definitely some value at looking at how we've done things, because while you were definitely correct, we survived for a long time without unemployment insurance, but I would say that during the Great Depression in the early 1930s, unemployment rates reached 25% without unemployment insurance, so one could argue we survived, but then when the crisis hit, it hit really, really badly. Anyhow, let me get started. I guess one of the first points that we heard mentioned was that the market was just insufficient for addressing insurance needs. And this actually reminds me of my political science 101 class way back when, because this is really what government is all about. It's necessary when markets can't meet demands, and that can often occur because there's lack of information or knowledge that people can't make rational choices, like how do you pick a prescription drug if you don't know anything about the science behind it, but also when you don't have enough resources to handle things at an individual or family level. That's where society has to come in. And one point that I wanted to mention about the U.S. perspective, about one more reason why government was necessary, is because interstate competition was really what kept the states from creating unemployment insurance in the United States. Even during the Great Depression, when people knew very tangibly it was necessary, there was this fear, well, if New York creates a program, they're going to have to raise taxes, and if New Jersey doesn't have a program, well, employers are going to leave New York and go to New Jersey because the cost of doing business would be much lower. And so I learned this as the basic prisoner's dilemma of game theory, when you can't have confidence or trust that all of the players are going to do what is in their mutual best interest, but instead act in their own individual self-interest, you end up with a suboptimal outcome. And that's what happened in the early 1930s in the United States, and that's why we needed federal legislation to get to an unemployment insurance program. And as Daniel did point out, constitutional fears were very real because the federal government had much less authority back in those days, and those fears were behind the design of our program. And so, to Sebastian's point, where we certainly don't want to create a program that doesn't do much good, or even worse, does harm. On the other hand, political exigencies are a reality that we have to live with, because sometimes it might be better to get something that is not optimal, just that we can actually lead to a greater good. And I think in the U.S. system, that could definitely be said, that I think even in the 1930s, people didn't necessarily think it was the best way to go about creating a program, but we have unemployment insurance now, so I've got to give them credit for that. The next point I wanted to mention was that member states can't handle the economic crises on their own. And I would agree with that wholeheartedly. Even in the last recession, we saw the U.S. states, even with the substantial federal involvement and support, were unwilling to take on a lot of extra risk and cost on their own. And I'm going to try to take something really complicated and boil it down simply. We have a permanent extended benefits program that triggers on when unemployment rates reach certain levels, and it has optional ways to trigger on. Well, under normal circumstances, this program is paid only 50% by the federal government and then 50% by the states. But in the first really big piece of legislation enacted in response to the Great Recession, the Recovery Act that some of you may have heard of, it changed the rules temporarily so that this extended benefit program would be 100% federally funded. Well, because of that, all the states now who could trigger on wanted to be on because they wouldn't have to pay for any of it. So we had about 25 or so states that didn't have the optional triggering mechanism in their laws. They amended their law to temporarily have that triggering mechanism so that extended benefits would be payable, because I like to joke, it's like, well, when you've got mom or dad's credit card, hey, I'm buying drinks tonight. It's the same thing here. The states were much more willing to make extended benefits available when they didn't have to pay for it. And so that was one of the things that made my professional life so difficult, because every state refused to be on extended benefits for one single week that wasn't subject to federal payments. So literally sitting there with calendars and, okay, if you trigger here, then the triggering off day is there, because they would not pay for a single week of benefits. So I think that is something that is true. Next point that I think was made up pretty poignantly is that we need an EUBS for macroeconomic stabilization. Well, one thing I would point out, as bad as the Great Recession was in the U.S., it was just one recession. We did not have a double-dip recession like many or some European countries had. And one of the reasons might be because of the federal role in unemployment insurance. And we at the Department of Labor commissioned an independent evaluation of the role of UI as an automatic stabilizer during the recession. And it came out in 2010. And the results were pretty good. Now, I will want to remind everyone, though I'm sure it's pretty obvious, that the weekly benefit amounts in the U.S. system are not nearly as generous as it is in most European countries. So, of course, one wouldn't necessarily expect the macroeconomic stabilization effect to be as significant when you're talking about a smaller benefit amount. But still, the results were very, very promising. What we call regular unemployment benefits, which are generally the first 26 weeks that are paid by the states, that closed by about 1/10 the real, I gross domestic product shortfall that was caused by the Great Recession. And then the extensions of benefits, which is where the federal role came in, both with the permanent extended benefits program and then the discretionary emergency unemployment compensation program that was also created, well, that closed the real GDP shortfall by about 1/12. So altogether, we saw a pretty significant role of macroeconomic stabilization of unemployment benefits, and particularly for the federal benefits, and I think that's something that's really noteworthy. And this study also was talking about the multiplier effect of UI benefit payments. And we've had some varying studies about, okay, for every dollar spent, how much economic activity is generated. And this study said that that it was $2 of economic activity that was generated from every dollar of benefits spent. And we've seen some other studies saying that really of all of the things that were in the Recovery Act and some of the other things that were done in the U.S. to try to respond to the Great Recession, that this had in many ways the biggest immediate impact, because guess what? Unemployed workers spend this money. They're not saving it. They need it. And so I think that is something that is very important. And I'm going to apologize in advance. I know I have a lot to say and can take too long, so give me the hook if I'm getting a little too long-winded. Another observation I have is about the idea that equivalent systems are easier to implement. And I don't know if you mean easier from the political perspective, because I think that's pretty obvious that that is the case. But if you're talking about actual administration and operation of the program, I would say that it's not necessarily the case. And one thing that you may not be aware of is that even though we have all of these federal benefit programs in the United States, the federal government does not administer them. It's not a federal employee out there making eligibility determinations and making the payments. The states actually administer the programs on behalf of the Secretary of Labor under agreements. We have regulations, operating instructions that the states have to follow, and they run the programs for us, and we just give them all of the money for the benefits and the administration. And I just wanted to point that out. When you're thinking about what's easier, there are different administrative approaches that can be taken to mitigate some of those concerns if a genuine system is one that you're thinking about trying to achieve.
The states don't even pay for the administration?
Oh, none. Actually, for both the regular like benefits that are paid under their own law, as well as the federal benefits, they get grants from the federal government in order to run their program. Actually, that's part of the original architecture of our program, of how we got to UI in the United States, because as you had pointed out correctly, there were constitutional concerns. So technically, from a legal perspective, no state is required to have a UI program. There are really, really big incentives. And the incentives are, number one, you run a UI program that meets certain requirements, guess what? Your state will get a grant to administer this program. But then the other really big incentive is tax credits. The federal unemployment tax is presently 6%. But guess what? Employers, you'll only have to pay 0.6% if your state runs a program that meets another set of requirements. And so it's through these tax credits and administrative grants that overcame that prisoner's dilemma, because you lose some of that competitive advantage if your employers are going to be paying a high tax in a state, even if there isn't an unemployment program. But that's also how we got over the constitutional challenge, because the one authority that the federal government always had was to tax. And so we weren't mandating that the states do something, we were just using our taxing authority. And so that's how we I guess, were deemed constitutional by the Supreme Court. Okay, briefly I wanted to talk a little bit about the concerns about, I guess, interstate migration and portability of benefits. And that's, obviously we don't have the linguistic and cultural barriers in the United States that many of the European states face with respect to migration, so there probably is overall more migration. But that's something that our UI system easily accommodates. Actually, federal law prohibits states from not allowing someone to continue to collect benefits from that state if they move to another state to search for work. We also have a provision requiring states to combine employment in establishing eligibility. So if I worked for a few months in Virginia, and then I worked in DC, if all of that work experience is during the right period of time when my eligibility is going to be established. All of that will be combined, and then the benefit costs are shared proportionately. So that is something that, that can be done. The only difference would be if you're not, say, commuting across borders to work and you're actually moving to search for work, well, then you would have to register for work in the state where you're going and probably participate in other active labor market measures in that state. But that's something that can be accommodated pretty easily. Okay, one of the biggest challenges, and it's funny, you know, because what strikes me as an American, but one of the things that does strike me is this reaction to transfers. You know, thou shalt not be any interstate transfers under no circumstances. And I understand why. It certainly is clear. But frankly, that isn't really an issue in the United States at all, believe it or not, when it comes to unemployment compensation. And part of it might be that we do have more of a common identity, a language, a history and culture than Europeans do. But I also wonder if part of it is because of how our programs are funded, because the states don't make payments to the federal government, employers do. And you know, in the recession, when even our federal reserves of, you know, money that were from those federal unemployment taxes ran out, we used federal general revenue that both individuals and employers nationwide paid into. And I'm wondering if how we finance our system shapes how it is perceived, because it's really perceived as a benefit coming from the federal government. It's not that, oh, Texans are paying for benefits to people in Massachusetts or whatnot. And so I wonder if how we fund it kind of changes how it's perceived, because it's not really easy to quantify, well, my state gave in this much, and then this is how much as benefits are going to your citizens. So it's just something that at least struck me as being very, very interesting. Okay, moral hazard. That was another thing that struck me a lot. In the United States, we don't think about institutional moral hazard because, frankly, it's not really possible, because we don't have a robust social safety net like most European countries do. So there isn't always some other program to shift you from in order to get federally funded benefits. But the type of moral hazard that we do care about is individual moral hazard. You know, are you truly searching for work? And that's why I guess active labor market requirements in the UI program are so popular, because not only are you helping people try to find new work, but you're making sure people are making you know, a due diligence in meeting all of the requirements to get benefits, because in the United States you have to still be in the labor market in order to receive unemployment benefits. And when I was thinking about what you could possibly do to address the concern about institutional moral hazard, the one thing I was thinking about was establishing some sort of oversight and monitoring program, because that's another big part of our federal role in overseeing the UI program. And there are different ways you can do that. You know, in the United States, we have several different programs. Some of them are actually peer reviews, where you'll get you know, people, a set of states together, and they'll review each other's operations. Are you doing things properly, consistent with your own law, consistent with federal requirements? And sometimes we'll have federal reviews where you'll actually have some federal employees going out and making sure that say eligibility determinations are being made properly and whatnot. And I was thinking that a similar approach might address some concerns about institutional moral hazard, because maybe you do want to really make sure that all the countries are vigorously and consistently enforcing their you know, active labor market requirements, and making sure that the people who are getting these European unemployment benefits are the ones who should be getting them.
The peer reviews we are doing in the council, they usually end in a whitewash. I don't poke your eyes, you don't poke mine.
Right. Understand. Yes.
Is that the experience in the U.S. as well?
It's not political employees who are, it's state career employees, and we don't generally have I think that level of concern, at least with unemployment compensation. I think, especially if you're getting, like, say, a state auditor to do this job. Auditors, you know, everything is black and white. You know, there's, you know, they're hair splitting, nitpicking. You know, you dot your I's, you cross your T's. So people will argue to the, you know, to the end about making sure everything is done properly. So that's not as big of an issue. Where you could see an issue is what do you do with the findings? How aggressively will you follow up on those findings? And that's where I guess I would suggest, if you are going to set up some sort of system like this, and if you are going to have some sanctions, have gradations of sanctions, because I know in the UI world we really have what we call nuclear bomb options. Take away a state's administrative grant or take away employer tax credits. Those are such huge consequences, we don't really want to ever, take advantage of them.
Have they ever been?
We actually made a state payback, gosh, this was in the 70s. I think it was like $500 million of their administrative grant because they weren't doing something properly. So it's something, it's very rarely done, but the threat is used frequently. Frankly, that was a big part of my job in addition to managing the Great Recession stuff. We would monitor all state legislative activity to make sure they weren't trying to enact something that was inconsistent with federal law, and we would have to give a lot of technical assistance and write lots of letters. If you enact this provision as drafted, this is what will happen to you. And thank goodness, almost always those bills just died, or they would be amended in a way to kind of sort of still achieve the policy objective, but not run afoul of federal law. So
Maybe commission officials would like that in Europe as well. We're not quite there yet.
Okay.
We're going closer to the
all right, I will
where
stop,
questions, answers.
but if
Do you have any, we'll give you one further point.
one further
Most-
point. Okay. Gosh, what else? There's just so much to say. Okay, I'm sorry. I guess harmonization, this is something quick. There was talk about, do you really need to harmonize benefits? We don't do that in the United States. Federal benefits are tied to what you got at the state level. The weekly benefit amount is the same as what you got from the state. And the number of weeks, because we count in weeks, not months or years, the number of weeks of benefits is also tied to what you got from the state. For example, the basic extended benefit that you get under federal law is the lesser of 1/2 of your state entitlement or 13 times your weekly benefit amount. So what does that mean in practice? Up to 13 weeks. So if your state gives you 26 weeks of benefits, then you would get 13 weeks of EB. But if your state only gave you 20 weeks, you would get 10 weeks. And so while harmonization, if you're harmonizing to a more generous system, would obviously improve both the, I guess, situation for unemployed workers and their families, and also would improve macroeconomic stabilization, harmonization can be a political issue too. And so I guess I would say you don't have to harmonize in order to have an effective program.
Thanks a lot. It was really fascinating.
Thank you.
I imagine trade union reactions in Europe if you were to offer them 13 weeks.
Oh, they'd have a hard time, but you could add a 0 to that, and then, everything
Exactly.
would be happy.
Then we are at a European scale. So with this, I think we should give the very patient crowd in front of us an occasion to come in. I know that sometimes when there are many people in the room, there's no questions, but let me see whether anybody wants to break the ice. Okay. First one over there. If you could please identify yourself.
Thank you, Mr. Chairman. Good morning, citizens. My name is Angelos Harelaftis, Epafos Advisors. There is a question to the new American administration and, of course, to the labor environments. What does your administration say for the debt you have in the USA, which, of course, is a big issue for the instability of the global economic situation? Thank you very much.
I think Susanna does not speak for the American administration,
Yes,
as she made clear.
I will restate to be 100% clear. First of all, I'm a career employee. I'm not an employee, I'm not a political employee, so I've been around for many administrations, not just the current one. But I am here in a personal capacity, not in a professional
Exactly.
capacity. So unfortunately, even if I had a clue about what the answer to your question would be for this administration, I'm really not in a position to answer, so I apologize for that.
Okay. As you can imagine, I would like to keep your question to the contents of this session. Over there, please.
Thank you. I'm Anna Dimitrievich from the European Commission. Just a quick question, if you could clarify a little bit, again, what you said about moral hazards at the state level, which you said is not so much of an issue for you. But you also mentioned that when you were talking about the the sorts of programs where 100% of the funding was provided by the federal level, all of a sudden states were not willing to finance even a single week of benefits themselves. So could you perhaps elaborate further why this is not overall an issue?
Well, I guess the institutional moral hazard isn't an issue because I don't think, because as I understand it, the concern with the institutional moral hazard in the European Union was that nations might shift people from, say, just general public assistance that is funded just by their own national budget to the European unemployment benefit program because they don't have to pay for it anymore. So they would want to shift people who, are they really in the labor market? Are they really looking for work? Who knows? They would just want to reduce their costs. The reason it's not, I think, as big of an issue is because there isn't as much to shift anyone to. First of all, unemployment benefits last a lot shorter period of time in the United States. And second of all, the, I guess, benefit programs that are available outside of unemployment insurance are not nearly as comprehensive and long-lasting as they are in Europe. I know welfare reform started in the 90s in the United States. So that's what I was getting at, that the institutional moral hazard isn't really a factor, but the individual moral hazard, there's at least concern about that, and that's been part of the debate and dialogue about unemployment benefits and why things like eligibility and reemployment assessments have been so popular and have been growing in unemployment, because it's a way to get at that individual moral hazard while still helping people find work.
It's understandable that the US is fascinating, as I said earlier, our big brother, but let me bring back perhaps the discussion also to our EU, European issues, because there's one thing which is, I think, very different. There's one concern that we have which does not really exist in a similar way in the United States, which is that for very large crises, and that is a little bit the non-linearities that you mentioned, there's a danger, and a life danger as we have seen in Europe, that actually the national government might experience serious financial difficulties. Market access, risk premia, whatever, right? And there's still shades, but these are things which I think you can exclude for state governments.
Actually, it was a huge problem in the U.S. The states went bankrupt.
Yeah, but in the relatively far, I know that there were.
No, I mean, like a few years ago, states borrowed like over $47 billion just from the federal government just to keep paying benefits. They borrowed from as I said, from the government, right? They were able to do that. But let's say, except for Puerto Rico, right, which is not a state, I know. We haven't really seen, at least this century, right, over the last 50 years, serious problems of market access by state government treasuries within the United States. Whereas we have seen that in the EU, we can have these cases, right? And that, of course, has a very strong impact on the extent to which a government can actually continue to protect its own citizens in the face of these very large shocks. And that's, I think, something which is different. I wanted to draw your attention to that so that the US experience is very instructive in many respects, but there's an additional layer here in Europe, which of course has to do also with the size of the national budget relative to the almost non-existent federal one. Sorry, there was a question here and then one over there. If you go first, please.
So, one observation.
If you could introduce yourself, please.
Hello, I'm Anne-Laure Delade, Deputy Director of CEPI, French Research Center. One observation is that the fact that people in the US, like New York people, don't realize that they are funding Florida people from Florida, you can find exactly the same mechanism at the domestic level in Europe. I mean, people from Paris don't realize that they are funding unemployment benefits of south of France, for example. So that is probably related to the way we are financing the unemployment benefits, but also maybe some sovereign issues. I have a question. So the unemployment benefits were implemented in the 30s, if I understand, by Roosevelt. And could you please, I mean, could we make a comparison here about the historical circumstances that made these unemployment benefits possible? It's a very broad question, but like, where are we now? I mean, I'm really not familiar with this issue, but where are we now at the political level, and what would be the historical perspective which would make these unemployment benefits possible?
This is probably a question which requires a treatise of several hundred pages, but I think I give perhaps first Sebastian 2 minutes, and then you a little bit less, because we'll hear you again later today.
I think a parallel in the situations can be, or at least up to a certain point, has been the perception that there is a necessity for change. And I mean, I think under Roosevelt, there was, and I'm not that familiar as you are with US history, but there was a feeling that the laissez-faire attitude of before was insufficient to stabilize the economy after the Great Depression or in the Great Depression, and the feeling that more fiscal tools needed to be implemented. And this unemployment insurance was one of the elements here to well, both improve the fate of the workers and to stabilize the economy. The parallel here would be that in Europe, at least up to, well, I don't know, the beginning of the year or so, and at least more in the southern countries, there has been the feeling that something has to be done about the Eurozone architecture in order to make it working for the future. I think where a very big difference is that Franklin D. Roosevelt actually was elected by a pretty decent majority. He had majorities in both houses of Congress. There was resistance, but in principle, he had the political institutions to do certain things. The Supreme Court was blocking him. I think in Europe, we are not there that we have political majorities for this. And well, of course, I could make up a scenario where we have them at the end of the year, but these are very unlikely scenarios, to put it that way. I think that's what I see, but I'm not an expert on this.
And also, as Caroline pointed out, a majority is not enough. We might actually need unanimity, which is a bit different.
I really don't have, I guess, much to add. I think Sebastian put it very plainly that the U.S. was experiencing a terrible economic crisis, and I think that's where they got the political will to try something bold to solve this problem, because it was a devastating problem. And as I guess you say, sometimes necessity is the mother of invention. Well, you know, the necessity of the Great Depression was the, I guess, spurred the creativity to find a way to get to unemployment insurance in the U.S.
And that's how we got to banking union. There was a question over there.
Yes, hello, my name is Séverine Ferraud from the Confederation of German Employers Association. I have a question for Mr. Dulin. You said that the idea of UBS has made a lot of progress, and there is also a political movement. You were just, maybe you can build on what you said just right now, your comments on evidence of having a new architecture of Eurozone and stuff like that. But when you say there is a political movement towards UBS, well, do you mean towards UBS, or do you mean there is a political movement towards the necessity of having stabilization mechanisms? Maybe could you be more concrete than that? Would be interesting. Thank you.
Okay, my perception is if you move back like 5 years, when I think this was the time when Laszlo Andor started to push this idea, there was very little support on the national levels. What I see now is that the French Treasury has been working on these proposals, that the Italian Treasury has been very intensively working on these proposals and actually been pushing those. And my perception is also that in parts of the German government, there is growing openness to that. If you look at discussions which I internally hold at for example, at the Ministry of Economics there. I know the German Finance Ministry is very much opposed to this. They are very much opposed to many things which are proposed by other countries in Germany. But I mean, relative to where we were 5 years ago, I'm seeing some progress there, and specifically also for this European unemployment benefit system. And let me just make one remark on this unanimity question. The question question is, of course, if you want to introduce it for all countries, you need unanimity. But if you would say, let's introduce that for a few countries, the other countries, of course, as far as I understand that, they would have to agree in a way, the other Eurozone countries. But if you say, well, let's introduce that scheme, and if the Netherlands don't want to participate, it's fine, then frankly, I think it's much easier to get their consent of introducing something for the other countries. So I would make this very blunt statement here that I think if Germany were to move on this point, which frankly I don't see at this moment, but if they were to move, I think there would be the possibility of implementation, at least at some core states, even if some other states still oppose the idea. Because, I mean, if you don't have to participate, why vote against this, especially if Germany pushes you?
As you have one takeaway you can take with you on the cross the Atlantic is there's no such thing as one Germany, right?
I'm wondering about the duration of the benefits. What I hear here is that it is dependent on the power of unions, it is dependent on some moral issue of how generous we would like to be, or it is dependent on the money available as if this were a fixed sum. I wonder if we don't need an element here that is more economic, like saying, how long should it be to optimize the stabilization function? And this should be a rather flexible condition.
Whom did you address your question to? Caroline.
Yeah, I do think that's a very interesting point, but I'm not entirely clear on what you meant. So you would propose that the duration of benefit it varies depending on the deepness of the recession, or how do you?
It should be related to some economic rationale of which kind of duration would optimize the stabilization function.
Yeah, it's okay. Well, I think in the project that we assessed three lengths of duration, and in the most of the schemes that we examined, the duration was 9 months, and I do think that this 9 months, it was chosen because it very well reflects what we, or it doesn't reflect very well what we have in the member states now, but this coverage, the length of the duration, it really had an impact on stabilization. The most stabilizing scheme precisely was the one with the very long duration of 12 months. So in that sense, I do think that in the project we already took this into account, that it has to be sufficiently long, and that this was really the main driving point. I also wanted to come back to something that Sebastian just said, about some countries being in and some countries being out. Of course, if it's an insurance scheme, then we really would want to avoid that countries can opt out, because then we might end up just with the countries that really need the scheme, and not so much with the countries that could be very powerful and help us in this.
Sorry, just a remark on this. You don't want to opt out at any time, but I think you could say, well, we start with those, and once you're in, you have to remain in. I think this would work. But coming back to Brigitte, I think this is an important point what you're making, and it links a bit to what Susanna said. In the US system, and I think this is a very interesting and from a macroeconomic point, important feature, if the recession proves to be very deep, you have these extended and emergency benefits, and they sometimes can be very long. I mean, in the Great Recession, I think they were extended to 99 weeks at a maximum. So this is we are coming into European dimensions here. So, but this is something which is partly triggered automatically, partly triggered by Congress through legislation. And if you look at all the simulations I know of, this has a very strongly stabilizing factor. And I think introducing something like this in Europe, also maybe in national systems, would be a very good idea if we talk about stabilization impact.
But did you not say at some point that you were paying for 1/2 of the time of national?
It was actually very complicated, because there were a layer of, there's a layer of actually 3 different programs. The first, generally 26 weeks or 6 months, were paid by the states. That was their regular program. But then our extended benefits program, the triggers aren't as responsive as they ideally should be. So that didn't trigger on soon enough during the Great Recession, and so the discretionary program that Congress passed, the Emergency Unemployment Compensation Program, that was created first, and it was amended and modified many times so that eventually that program provided about a year's worth of benefits. And so we had a layer of 3 different programs. Actually, as I was rushing out the door, this was, I guess, just a little graphic of spending during the Great Recession, and the green was that discretionary program, the red was EB, because it's probably much fewer weeks, and then the blue was what the states were paying for on their own. So, sorry, I did not have time to prepare a PowerPoint.
Okay. Final question?
My name is Clemens Fußt from IFO Institute in Munich. One thing that wasn't addressed on the panel was the asymmetry of the current situation. So the question maybe to Caroline, it must be somewhere in your big study. How do you deal with the fact that we now have countries with full employment and others with 20% unemployment? For instance, if unemployment goes from 20 to 18 in Spain and from 3 to 4 in Germany, would that mean that that Spain pays to Germany, or what's the idea? I'm not trying to be sarcastic about that. I'm really trying to understand.
That's a typical practical European question.
Well, I do think that's a very important question, and we do try to take this into consideration in the design of many of the features of the scheme. For instance, the fact that when we worked with the trigger is also based on a deviation from the norm of the country itself. So it's really looking at the experience that the country already had. And another question which reminded me which this reminds me of is, of course, the legacy of the crisis. Like, if we would introduce the scheme today, do we take into consideration what we have seen in the past years? Because then you end up with the very high unemployment schemes, and you could end up with the countries that were affected the most now starting to really pay into the scheme. And I do think that's a very important concern, but at least to a large extent, it's also a political question. Do we want to take this into consideration or no? So this will be, I think, one of the main challenges that we would be faced with if we were ever to introduce such a scheme.
Thanks a lot. This brings us exactly to our allotted time. I want to thank very much our panelists here for sticking so much to this constraint. Let me just add 2 housekeeping announcements. The first one is there will be coffee downstairs, but I think we have only 1 coffee machine, and so be patient. It would also be nice if you could not bring the coffee up here back in the room, because as you can imagine, the chance of spilling it is rather high. And the second announcement is that we have a choice here between having it nice and cozy and warm and stuffy air, or crisp and clear and cold. And I'm opt for the second proposal. Therefore, we will open here the lights upstairs, and it might be a bit cooler when you come back, but I presume all these bodies will then heat it up again. Thanks a lot. See you again at 11:30. Die Frage, das war klar, das letzte, nicht? Ich habe versucht, die rüber zu lenken. Okay, so very nice.
I hope that was what you were
expecting. Yes,
okay,
very good.
wonderful. Thank you.
And you'll be on the show again.
Yeah, though I know Martin had suggested we take a sweeping view, so I wasn't planning to go into any details.
No, that's very good. Yeah. This was very good. Give them some nuggets and I think it will stay.
Okay, wonderful.
Thanks a lot.
My pleasure.
You came over especially for us?
Yes, I did actually.
That's a big honor.
Well, this is a very interesting endeavor, and one that I hope will someday become realized. And from a personal perspective, it's kind of thrilling that there could even be a chance that America could help Europe something in this sphere. Because usually, we are looking to you all as a model for social protections. Like, if there's any way we can contribute to Europe, it's like from a personal perspective, it's kind of exciting.
Yeah.
So, so I do.
But you will really talk to some people here at the Commission or the Council?
I'm open to. I don't have anything scheduled for tomorrow yet, but yeah, I just figured it. I would play it by ear. If I get something arranged, great. If not, I will do a little sightseeing.
Should be called to people?
I mean, if you'd like to, I certainly would be happy to meet people.
Here tomorrow.
Well, I assume, yeah, because I'm going back over the weekend, so I don't imagine people will want to do anything on Saturday.
Okay. Now the commission, yeah, they are not. Okay. I think actually would it be interesting for you to meet, for example, some people in the German representation.
All right. Yeah.
As you can hear, everything is about Germany.
It's kind of you have to get German buy-in or nothing's going to happen.
Exactly.
Which hopefully there's a way to kind of change the rhetoric and dialogue and thinking.
You saw two Germans here. He's closer to the finance ministry, and he's closer to the SPD and the economic ministry.
Thank you for this context. Now have to find a seat for so I can enjoy the rest of it.
Grab a seat here.
Yeah.
I think it will thin out.
Okay.
Because I think your part was also what many people come for.
Oh, well, I hope they enjoyed it. I was trying to be sensitive to not
No,
dominate the questions a bit. Yeah.
it will be there, so maybe we can discuss it there, but we won't have time to write it.
Honestly, I don't think
So you think it will be looked at after?
although, as I said, our role is to contribute.
Yeah.
So that what then this would be still many different. I wouldn't expect a major, proposal before the Why the first of the presentation and not the second? The second, I presume it depends on rules, right? In the first, in the second round, the second, yeah. So, you only have one.
The question is it Macron or Mélenchon or Fillon?
That's the second round of the legislative is actually the majority here at the parliament. Of the legislative. Then it's up to the general elections.
But anyway, maybe we will tell you.